Welcome to Geojit Spotlight. Dr.V.K. Vijayakumar, Chief Investment Strategist, Geojit, shares his views on the reasons behind India's stock market underperformance in 2023. He will provide insights into the short-term market outlook and will discuss investment strategies that investors can consider the present scenario. Welcome, sir. Sir, India outperformed in 2021 and 2022, but we are underperforming this year. Why is India underperforming?
Yes, India is underperforming this year. Last year we outperformed most of the markets, developed markets as well as emerging markets. In 2021 also the returns were very impressive. But this year, in 2023, as we speak on 28th April, Nifty is down by more than 1% year till date. So this is big underperformance. To understand the reasons for this underperformance, we have to go back in time to 2020 and 2021. After the crash in March 2020, the markets staged a spectacular rally, a one-way rally, which took the Nifty from 7,511 in March 2020 to 18,604 in October 2021. This was a very unusual, unique one-way rally, and this rally attracted a large number of new investors into the market. The total number of demat accounts in India exploded from 4 crores in March 2020 to about 10 crores by September 2021. Now it is about 11 crores. And this influx of large number of new investors into the market led to some irrational, overconfident exuberance in the market. These new investors who did not have much of an idea about the market, the fundamentals or the economy, they started buying recklessly, and this pushed the markets to very high levels. Foreign institutional investors sold heavily because the valuations were very high. Even in our interviews given in the letters that we wrote around October, November 2021, we have cautioned that markets are overvalued. But when FIIs were selling in the market heavily, this newbie investors and the DIIs were heavily buying. That supported the high valuations. Things have changed now. For the last 18 months, there is no return from the market. Nifty was 18,604 and now it is below that, around 18,000. So there are no returns from the market, and the large number of disappointed newbies have left the market. The number of active trading accounts have been declining steadily for the last 6 months. So this exuberance in the market is gone. And the FIIs have been sustained sellers in the market from January this year, and their selling could not be absorbed because the retail exuberance was not there, and that resulted in sharp corrections. And the valuations also have become reasonable now. After this time correction of 18 months, valuations have become reasonable, and therefore in April, FIIs have turned buyers. Even now, this year they are net sellers to the tune of around 22,000 crores. But in April, they have already bought stocks worth 6,000 crores. So the re-entry of FIIs is imparting some resilience to the market. And that is why in April, Nifty has rallied close to 5%.
What is the short-term market outlook?
The short-term market outlook continues to be very cloudy, very uncertain, because there are many uncertain factors relating to the global economy and the US interest rates. These are very, very important. We do not know how this is going to transpire. I will share with you some positives as well as the negatives, and then we will try to see which of these positives and negatives, which of the negatives and positives are going to be dominant, because that will determine the direction of the market. We'll start with the negatives first. During the last 1 year, interest rates have been going up. particularly in the developed world, everywhere, but particularly in the developed world. In the US, their central bank Fed raised interest rates by 475 basis points from the beginning of last year. So when interest rates rise, money will move from equity to debt. Rising interest rates are negative for equity markets. So this is the negative factor. Second negative factor is global growth will be very low this year compared to last year and the year before that. IMF's projection of global growth is only 2.8% this year. Therefore, a slowing global growth will impact India's growth also via lower exports. So corporate earnings can be less than expected when earnings decline. These are the two negatives. The two positives are, in spite of this gloomy global economic scenario, India is doing well. India is the fastest growing large economy. It was the fastest growing economy last year before last, will be this year, and will next year also, according to IMF's projections. For 4 years consecutively, India will be the fastest growing large economy in the world. And this will attract a lot of investments into India. This is one very positive factor. Second positive factor is that the banking crisis in US and also in Europe did not impact the Indian banking sector at all. Our banking system exhibited great strength and resilience during this developed country banking crisis. So that is a very strong positive as far as the Indian economy is concerned. So these are the two important negatives and positives. We do not know which of these positives and negatives will become dominant in the months to come. If the US economy slows down, the Fed may pause rate hikes with one more rate hike in early May. And if the US economy slows down, and if the recession that follows, if at all a recession happens, is shallow and short-lived, then the economy, global markets will rally, Indian markets can outperform. On the other hand, if inflation continues to be high in the US, and if the Fed continues raising interest rates, that can lead to problems for the global economy. We do not know, so we will have to wait for the situation to evolve.
So, what should be the investment strategy in this present scenario, and which sectors should investors focus on?
From the beginning of this year, from January onwards, we have been communicating to our clients, to all the investors, that the ideal investment strategy this year in 2023 would be a multi-asset allocation strategy. The logic behind this multi-allocation strategy, multi-asset allocation means you should be investing in fixed income like bonds, deposits, gold and equity. The logic behind this strategy was that this year interest rates will be rising, and therefore fixed income will give more returns. Therefore, there should be weightage for a fixed income investment. Secondly, the uncertainty continues to be high because the war in Ukraine is still raging. Therefore, investment in gold will be a safe investment. And also, investment in equity should continue. This was the message that we conveyed, and this strategy has paid off well during the first 4 months of this year. But going forward, we would slightly change the strategy because interest rates are not going to rise further. In India, perhaps there may be one more 25 basis point rate hike, or perhaps no rate hike at all. We do not know because inflation is coming under control. So towards the end of this year, starting from the second half of this calendar year, the exposure to equity should be increased. And what should be the sectors? Now, we have been very bullish on the financial sector, particularly banks, for the last 1 year. We have done many videos on that. And the banks have delivered very well. Excellent results from the banking sector, particularly from blue chip stocks like ICICI Bank, followed by HDFC Bank, etc. So the banking sector has done well. The banking sector will continue to do well, but we should not expect fantastic returns from the banking sector in the next 1 year, as much as we got during the last 1 year, 1.5 years. The reason is that the interest margins of the banking industry is slowly coming under pressure because deposit rates are rising. So, but then it will continue to do well for the next few quarters. But then after that, the returns will be only moderate. But then it makes sense to remain invested in financials, particularly banking. NBFCs can do better than banks. Banks may report 15 to maximum 20% growth, the best banks, whereas NBFCs can report a much higher earnings in the next 1 year. Then we have been bullish on the capital goods space. Capital goods are doing very well. They will continue to do well for an extended period of time. Construction related segments, particularly cement. The reason why cement we are emphasizing is 2024 is the election year. So the next half of this calendar year is going to witness massive expenditure by the government. So this public expenditure by the government on infrastructure is going to create very good demand for all the construction related segments, particularly for cement. So cement will do well, paints, adhesives, all of them will do well. FMCG is performing okay. So these are the important sectors where we should be focusing. Then IT, the results have disappointed, particularly from large caps. In large caps itself, Infosys is disappointed, much more than TCS, HCL Tech or Wipro. So an important trend is that large cap IT is not doing well, but mid cap IT is bucking the trend. The results are very good in mid cap IT. Therefore, investors should continue to invest in mid cap IT. They will continue to do well for an extended period of time. For large caps, the prices have corrected, but if the prices again correct when the market turns weak, large cap IT can be accumulated. In brief, for the second half of this calendar year, the exposure to equity can be increased because the returns in 2024 and beyond will be very good.
Thank you, sir. Thank you very much.
Thank you.